everyone, I'm Erin with Bank of England Mortgage, and I'm here with Jake Alexander from Action Accounting.
Hey, everybody.
And we're just going to talk about some simple questions here. One question is, we have the Tax Cuts and Jobs Act, which I know is set to expire in 2026.
Yep.
And I'm just wondering, what does that have to do with mortgage?
Whew. It could potentially have a lot to do with mortgage. And just sort of a brief recap, the Tax Cuts and Jobs Act came out in 2017, and it made a lot of changes to the tax code. It was actually the biggest change to the tax code since, don't quote me on this, but I think like 1987. So it changed a lot of things with a standard deduction, personal exemptions, child tax credit amounts, a lot of things that it came out and changed. And one of the biggest ones was the amount of the standard deduction. So in the world of mortgage interest and real estate taxes, where that becomes important from a tax perspective is you can potentially write off the amount of mortgage interest and real estate taxes that you pay in a year if that amount combined with a few other items is higher than the amount of the standard deduction. And so if you file your taxes married, the standard deduction right now is $26,000. So just under $26,000. And so technically for someone to get credit for the mortgage interest and real estate taxes that they're paying, it's got to be higher than that number.
Okay.
Maybe I would be surprised if they don't repeal, reform, or extend, but technically right now, the Tax Cuts and Jobs Act is set to expire at the end of 2026. So if that were to happen and things were to go back to where they were, that standard deduction amount would be cut in half. So it would be closer to $13,000 for folks that file their taxes married.
Okay.
Therefore, if your mortgage interest expense, your real estate taxes expense, the other items that fall in the same buckets only has to be higher than $13,000 for you to now get a benefit for it. And so hopefully that makes sense. Try to explain that as simple as possible.
So you're saying you can't do both. You can't have both the mortgage tax credit.
No, you don't.
I'm sorry, deduction.
Yeah, you don't do both. It's one or the other, whichever one's higher. And so right now, for a lot of folks, when that happened, their mortgage interest and real estate taxes weren't high enough for it to make a difference. So they were just taking advantage of that standard deduction amount. If that goes down, in effect, a lot more people will be able to take advantage of that deduction again.
Okay. Reminds me of a shoe sale.
That's exactly what I was thinking too.
It's like 50% off or buy one, get one free, whichever is less or something like that.
There you go. Essentially, yeah, it's either or, whichever one's going to give you the most credit.